When a client owes the IRS, your first job is picking the right payment channel. On the EA exam, they love mixing up similar sounding options. Electronic Funds Withdrawal, or EFW, is the pay option inside eFile software. That is not the same thing as IRS Direct Pay, which is a separate online payment tool. Same idea, electronic payment, but different setup and timing. Here are the common payment methods the IRS accepts: EFW, direct pay, credit or debit card, check or money order, EFTPS, same-day wire, and even cash through approved retail partners. Installment agreements aren't a method like a check, but they are an approved way to pay over time. Exam tip: if an answer choice is tax court, that's not a payment option. Timing matters. A payment does not have to be sent the same day the e-filed return is transmitted. You could e-file in January and mail a check later. The key is the due date. As long as the payment is mailed by the return due date, it's considered timely. That's a classic EA exam nuance. File now, pay later, but still by the deadline. Now refunds. A taxpayer can take the refund as direct deposit, get a paper check, or apply it to next year's estimated tax. They can also split it, part to next year's estimates and the rest paid out, or split the direct deposit across up to 3 different accounts. When you see split refund, think multiple destinations, but with limits. Direct deposit has qualified account rules. The accounts must be in the taxpayer's name and held at a U.S. financial institution. Qualified accounts include checking, savings, and even certain retirement accounts like IRAs or money market accounts. You generally can't direct deposit to a regular credit card account, but you can deposit to some prepaid debit cards. Also, the IRS limits 3 electronically deposited refunds into a single account per year. Here's the rule that trips people up. Once the IRS accepts the return, the direct deposit election can't be rescinded. You can't change the routing number or account number after acceptance. So you must verify the numbers with the taxpayer every year. If the account closes after filing, the IRS will try the deposit, the bank rejects it, and then the refund typically defaults to a paper check. Marisol is a tax preparer. She has 3 clients who all share the same bank account, 2 elderly parents and their adult son. They'll file separate returns, but each wants their refund direct deposited into that one account. Is this permitted? The choices include not allowed at all, allowed only for the parents, allowed because of a 3 refund limit, or each must use separate accounts. Think about it. The correct answer is yes, it's permitted because a single account is limited to 3 electronically deposited refunds per tax year. 3 separate returns going into one account hits the limit, but doesn't exceed it. The tempting wrong choice is only 1 refund per account, because it sounds like an anti-fraud rule, but the actual cap is 3. Brianna owes $4,000 when she files her tax return, but she can't pay the full balance by the due date. Which option is not an acceptable payment option? The choices include contesting in U.S. tax court, paying online at pay.gov, paying by credit card, or requesting an installment agreement. Think about which one isn't really a payment method. The correct answer is contesting her liability in the U.S. tax court. Tax court isn't a post-filing payment alternative for a balance due shown on a filed return. Paying online, paying by card, and requesting an installment agreement are all valid ways to handle the balance. Tax court jurisdiction is limited, and it's not a payment channel.